Hello, my fellows. The American dream, a house, a yard, maybe even a white picket fence. For most, it's more than just a place to live. It's security, investment, identity. But this dream comes with a price. And that price, it's usually a mortgage. Today, we're pulling back the curtain on one of the most important and least understood forces in American life, the mortgage system. Where did it come from? How does it really work? And why does it keep crashing the economy? The idea of owning land is older than America itself. But in colonial times, most people didn't buy a home the way we think of it today. Land was often granted or inherited, especially on the frontier. Credit was informal, loans from family or wealthy landowners. In urban centers like Boston and Philadelphia, early banks sometimes issued land-backed loans. But there was no formal mortgage industry. Owning a home outright was the goal. Mortgages were rare and carried a social stigma. Debt meant failure or desperation. As America expanded westward and cities grew, so did the need for credit. Local banks began offering loans backed by real estate, the earliest form of the modern mortgage. Terms were harsh. Down payments were often 50% or more. Terms lasted 3 to 5 years, ending in a balloon payment, the full amount due. There were no fixed-rate, 30-year mortgages yet. Mortgages were risky for both borrower and lender. If land values fell or crops failed, foreclosure followed. By the 1930s, nearly half of all American mortgages were in default. Foreclosures soared. Families lost homes. Banks collapsed. The mortgage system was unstable, fragmented, and entirely private. Homeownership fell sharply. To stabilize the system and prevent mass homelessness, the federal government stepped in, permanently reshaping American home finance. In the 1930s, the federal government built the foundations of the modern mortgage system. Key agencies created: Homeowners Loan Corporation, HOLC, refinanced defaulted loans. Federal Housing Administration, FHA, insured new mortgages, making banks more willing to lend. Federal National Mortgage Association, Fannie Mae, created in 1938 to buy mortgages and provide liquidity. The FHA standardized a 30-year fixed-rate mortgage with low down payments, a radical innovation that made homeownership achievable for the middle class. After World War II, the U.S. saw an explosion in homeownership, and mortgages were at the heart of it. The GI Bill guaranteed home loans for veterans. Developers like William Levitt built mass-produced suburbs, and banks flooded in with easy credit. By 1960, over 60% of Americans own homes. But not everyone got the same deal. FHA and banks systematically denied mortgages to black families and people in minority neighborhoods. Redlining, codified by federal agencies, entrenched racial wealth gaps that persist today. In the 1970s and 80s, a new idea transformed mortgages again: securitization. Instead of holding loans, banks sold mortgages to investment firms. These were bundled into mortgage-backed securities, MBS, bonds made from monthly mortgage payments. Fannie Mae and Freddie Mac played central roles in this process. This changed everything. Mortgages were no longer personal loans. They were global investments. By the early 2000s, home financing had turned into a feeding frenzy. Subprime mortgages to risky borrowers exploded. Adjustable-rate mortgages lured in home buyers with low initial rates. Banks sold these risky loans as AAA-rated investments. Then the bubble burst. In 2007-08, home prices plummeted. Over 10 million Americans lost their homes. Global markets collapsed, triggering the Great Recession. Cut to government bailouts, Occupy Wall Street footage. Wall Street was saved. Homeowners? Many were not. In response to the meltdown, Congress passed the Dodd-Frank Act in 2010, created the Consumer Financial Protection Bureau, CFPB, added stricter rules for lenders and mortgage-backed securities, limited risky practices like no-doc loans, no income verification. The mortgage market recovered, slowly. But lending standards tightened, home prices rebounded, and the rental market grew. Today, mortgages are easier to access online, but harder to afford in real life. Average home prices have soared, especially in cities. Student debt and stagnant wages make saving for down payments difficult. Private equity and large landlords now buy thousands of homes, pricing out families. Meanwhile, the U.S. mortgage market remains enormous, around $12 trillion. The system that built the middle class now risks locking the next generation out. Can the mortgage system evolve again? Emerging trends: digital underwriting and AI credit scoring. Green mortgages for energy-efficient homes. Rent-to-own models, co-ownership, and community land trusts. The American mortgage has always been more than a financial tool. It's a reflection of who gets to belong and who gets to build wealth. Pause. To understand American life, follow the money. And the mortgage, that's where it lives. Home is where the heart is, but the mortgage is where the history lives.